Hi, I'm Calvin Rose, and welcome to Invest Smarter. Please hit the like, subscribe, and notification icons so you can keep investing smarter. In today's video, we're going to talk about mortgages, and specifically, should you take out a 30-year mortgage, or should you take out a 15-year mortgage, or should you pay off your 30-year mortgage more quickly? Let's take a look at what the financial impacts of each one of those decisions might be and how it might affect you going forward. First of all, this idea won't work for everyone, so you have to look into your specific situation, work with your financial advisor or tax accountant, and understand if this is going to work for you. But let's take a look at the case where you could afford a 15-year mortgage if you wanted to do that. And the question is, should you, and will you benefit from it? So let's take a look at a simple model here. So what I've modeled out here is it's a $400,000 house. Now you can make this whatever amount you want. These numbers still work. They scale up and down as long as the interest rate you're paying isn't at or above the amount you can make on an investment account. You'll understand why I'm saying that in just a couple of minutes here. So we're talking about a $400,000 house. We put down 20% and we take out a 30-year mortgage. Now, the pitch from the banks is, but if you can afford it, why don't you take out a 15-year mortgage? Well, why would you want to do that? Well, because here in the 30-year case, you're going to pay $225,243 in interest alone, which is a lot considering that you're borrowing $320,000. So in the 15-year case, you're looking at a much lower total interest payment of just a little over $100,000, $104,000. So your savings over the 30-year case is $121,000. That's really appealing. That sounds great, doesn't it? So why wouldn't everybody do this if you can afford the extra payment? Well, I'm going to show you why. Let's take a look. So let's go back to the 30-year case. Now, in this case, what I'm going to do is I'm going to take out a 30-year loan, but instead of putting the extra $870, I think it was, the extra amount, $841. Instead of putting the extra $841 into my mortgage payment, I'm going to put it into an investment account. So what happens after 15 years of this? And we're going to assume here that in that investment account, we're getting 7%. You can put in as low as probably 6 or 5%, and it'll still work. You just won't get as big of a difference because you're getting closer to the interest rate you're paying. So the less you can pay here on the interest rate and the more you can make here, the better this works. But let's take a look at what happens if we do that. So remember, we could have saved $121,000 by paying off the mortgage in 15 years instead of 30 years. But let's look at what happens and what matters here. So what happens after 15 years if instead of taking that extra money and putting it toward the mortgage, we take it and put it in an investment account, making 7%. So after 15 years, we will have $417,400 in equity in the house. So that we have a net worth in our house of $417,000 roughly. But our investment account will be $261,634. So we've got a very nice emergency fund, and we've got a total net worth of $679,000. That's pretty good. Well, what if we look at the 15-year case? How does that compare? Well, in the 15-year case, we have a lot more equity in the house because it's paid off. So we've got $623,000 after 15 years, and the house is paid for, so we won't have a mortgage payment anymore. But our total net worth is only $623,000. We have nothing in the bank unless we saved money outside of that situation. So we end up after 15 years, in this case with $679,000. After 15 years, we end up with a net worth of $623,000. So close, but we're still better off in the 30-year mortgage case. Now, what happens after 30 years? Well, after 30 years, and by the way, for the next 15 years after we pay this off, we're going to take not the $841. We're going to take the entire mortgage payment, which I think is over here. Yeah, we're going to take the entire mortgage payment of $2,355 and shove it into our investment account starting in year 16. Okay, so we're going to be putting a lot more money away later, and let's see how this plays out. So let's go back here and take a look. So after 30 years, now we have, because of inflation, our house is worth almost $1 million, and our investment account is worth more than our house. It's worth almost $1 million as well. So we have almost $2 million here, $1.954 million of total net worth in the case where we took out a 30-year loan and invested the extra mortgage payment in an investment account. How about in the case of the 15-year loan? Well, in the case of the 15-year loan, our house again is worth almost $1 million, right? Because the house has appreciated. It's paid off in both cases. So again, our house is worth $970,000, but our investment account's only worth $732,000, even though we've been stuffing a much larger amount in there over the last 15 years. So our total net worth is $1.7 million here versus almost $2 million here. So it's a difference of $250,000. So that makes the savings of $121,000 not seem worth it, right? Because we're $250,000 ahead by paying it off over 30 years and stuffing our investment account, and we end up with a really nice emergency fund or nest egg. There's a lot you can do with $1 million. So this is clearly a win if you can afford to do it, if it makes sense for your situation. Of course, you might already be 15 years into your mortgage. That'll change the dynamics of this. But certainly if you're starting out, this is a great way to look at things. I'm Calvin Rose, and thank you for watching Invest Smarter today. If you like this video, please hit the like, subscribe, and notification icon so you won't miss one of our upcoming videos on how to invest smarter. That's all for now.